The World Bank just issued a grave warning. Global debt is exploding at the fastest pace in history. If governments don't act now, the world could face a crisis unlike anything since 2008. The World Bank warns global debt is rising faster than economic growth, creating structural vulnerabilities threatening worldwide financial stability. Many countries face soaring borrowing costs as interest rates remain high, pushing weaker economies closer toward potential sovereign debt defaults. Debt accumulation accelerated after the pandemic, and governments failed to reverse temporary emergency measures, turning short-term borrowing into permanent burdens. The World Bank highlights how emerging markets are especially fragile, lacking fiscal buffers necessary to withstand sudden external shocks effectively. Rising global interest payments consume government budgets, reducing funds for healthcare, infrastructure, education, and essential economic development initiatives. The debt crisis deepens because economic growth slows while liabilities continue expanding, creating a widening gap with dangerous long-term consequences. Many nations rely on short-term external loans, exposing them to refinancing risks that intensify when global financial conditions rapidly tighten unexpectedly. The World Bank warns that if capital inflows reverse, vulnerable economies could face currency collapses and severe funding shortages. Developing nations already struggle with depreciating currencies, increasing the real cost of repaying dollar-denominated debt obligations significantly. High global debt also restricts monetary policy flexibility, making central banks more cautious when attempting to stimulate slowing economies effectively. Private sector debt continues rising, particularly among corporations operating within countries. Suffering from weak regulations and unstable financial conditions, household debt grows rapidly as families use borrowing to offset rising living costs, creating long-term financial strain across entire populations. The World Bank fears synchronized global slowdown where debt pressures amplify downturns, triggering widespread unemployment and reduced consumption. Debt restructuring becomes harder as geopolitical tensions grow, complicating international cooperation. It's required to solve large-scale fiscal challenges. Investors increasingly demand higher yields, making refinancing old debt more expensive and accelerating fiscal deterioration among fragile nations. The World Bank stresses that debt transparency remains low, reducing trust between lenders and borrowers, worsening market reactions during crises. Many governments hide liabilities through state-owned enterprises, increasing total debt beyond what official statistics publicly reveal today. Shadow banking expands in several regions, adding opaque financial risks. The World Bank says remain poorly monitored internationally. Global supply chain disruptions continue pressuring prices, forcing governments to spend more on subsidies and social programs. Already overs terrified. The World Bank notes climate-related disasters increase borrowing needs, especially for poorer nations unable to fund emergency recovery efforts. Rising food prices force governments to intervene, increasing fiscal burdens while worsening long-term debt. Sustainability challenges everywhere. Political instability grows when citizens face unemployment, inflation, and reduced public services, creating pressure on governments already over-leveraged. The World Bank warns that social unrest becomes more likely as economic inequality widens under heavy national debt. Burdens. Debt-laden countries increasingly turn to international lenders, accepting strict conditions that often limit spending on essential services. A global interest rate shock could trigger cascading defaults across developing economies with weak financial positions. High debt levels make global markets more sensitive to small disruptions, amplifying volatility across stocks, bonds, and currencies. Foreign investors pull money from risky markets quickly, accelerating crises through rapid capital flight and currency depreciation. The World Bank stresses early warning indicators are flashing red, similar to periods preceding previous major financial crises. Banks holding large Amounts of government bonds face losses if nations restructure debt, threatening domestic financial stability. A global recession would significantly worsen debt burdens as tax revenues fall and borrowing needs simultaneously increase. The World Bank urges countries to improve fiscal discipline, though political constraints make rapid action extremely difficult. Global debt levels now exceed historical records, surpassing previous peaks seen during major global economic disruptions. The World Bank warns the pace of accumulation indicates structural weaknesses not easily fixed by short-term policy adjustments. Developing nations require urgent reforms to reduce dependency on volatile foreign capital inflows, supporting government budgets. Digital finance increases access to credit, but also exposes consumers to predatory lending practices that worsen household indebtedness. Global energy transitions require massive investments, adding more pressure to already strained government balance sheets everywhere. The World Bank highlights aging populations reduce economic productivity. Shrinking tax base is needed for sustainable debt repayment. Productivity growth remains weak, limiting long-term economic expansion and undermining government's ability to stabilize national finances. Fiscal deficits widen as governments struggle to balance rising costs with political demands for economic support. Measures central banks face conflicting goals, balancing inflation control with growing risks of worsening national debt. Conditions. The World Bank warns poor governance exacerbates crises by enabling financial mismanagement and inefficient public spending practices. Corruption increases the cost of borrowing as lenders demand higher premiums to offset perceived governance risks. Global trade slowdown reduces export revenues, making it harder for developing countries to service external debt obligations. Commodity-dependent economies suffer when market prices fall sharply, destabilizing fiscal positions reliant on natural resource income. The World Bank stresses coordinated international action is essential to prevent widespread economic damage from escalating debt pressures. Debt forgiveness programs remain limited, leaving many nations trapped in cycles of borrowing to repay previous loans. Structural reforms require political will, something many governments lack due to fear of public backlash or instability. High debt reduces investor confidence, discouraging long-term investment needed for economic recovery and job creation. The World Bank warns that countries delaying reforms face deeper recessions once financial conditions deteriorate further. Rising interest rates create global liquidity shortages, making it harder for governments to find affordable financing options. The debt crisis also threatens global development goals, slowing progress in poverty reduction, education, and healthcare improvements. Multiple nations default simultaneously. International financial institutions may struggle to provide adequate emergency support. The World Bank highlights how fragile economies risk being locked out of borrowing markets entirely, worsening their crises. Countries with high youth unemployment face long-term socioeconomic damage exacerbated by crushing national debt burdens. High inflation reduces real incomes, increasing reliance on loans to maintain basic living standards across vulnerable communities. The World Bank warns debt servicing costs increasingly exceed spending on essential public services. Across many regions, borrowing from non-traditional lenders introduces new risks, particularly when loan terms are opaque or politically motivated. Global debt trends suggest this crisis could last years unless decisive structural reforms are implemented quickly. Rising geopolitical tensions complicate coordinated responses, making debt restructuring negotiations slower and more unpredictable. Financial markets remain highly reactive to negative debt news, amplifying panic and worsening systemic vulnerabilities. Central banks risk triggering recessions if they tighten policies further to control stubborn inflation pressures. Globally, countries with weak currencies face harsher borrowing conditions as foreign lenders demand significantly higher risk. Premiums. The World Bank warns persistent fiscal deficits push nations toward unsustainable debt paths difficult to reverse. Later, governments often delay reforms until markets force harsh adjustments, increasing long-term economic damage. Dramatically, global inequality grows as poorer nations struggle with debt while wealthier countries maintain access to affordable financing. Migration pressures increase when economic conditions deteriorate, creating regional instability and heightened political tensions. The World Bank stresses that without transparency, investors cannot accurately assess risk. Worsening global financial imbalances. Large economies with heavy debt loads create spillover risks that can destabilize global markets if conditions worsen. International banks face rising exposure to risky nations, increasing concerns about cross-border financial contagion events. Debt crises reduce business confidence, slowing private investment essential for economic growth and long-term job creation. The World Bank warns heavy debt crowds out productive spending, making economies less competitive and more vulnerable. If global growth slows significantly, debt-to-GDP ratios could spike, triggering urgent fiscal adjustments across many countries. Rising default risks strain international credit markets, making lenders more cautious and less willing to provide capital. The World Bank highlights the danger of ignoring hidden liabilities that increase future financial instability. Many nations rely heavily on foreign currency loans, exposing them to major risks if exchange rates suddenly weaken. Debt accumulation limits innovation investments, slowing technological progress essential for future economic expansion. Persistent fiscal mismanagement creates long-term structural problems that cannot be solved through temporary borrowing strategies. Debt relief programs require global cooperation, something difficult to achieve during periods of geopolitical conflict. The World Bank warns governments must adopt sustainable fiscal frameworks to stabilize debt trajectories before crises escalate. Countries that implement strong reforms early recover faster, avoiding severe economic contractions and social instability. Without action, the global debt crisis could trigger widespread defaults, financial turmoil, and prolonged economic stagnation.